Welcome to the deep dive. Today, our mission is to really get under the hood of Circle Internet Group, Inc. That's ticker CRCL. They're the company behind USDC, the USD coin.
And this isn't just, another crypto company analysis.
No, not at all. This is crucial because the whole game changed with the Genius Act of 2025.
Yeah.
It's basically reshaped digital finance in the U.S.
Absolutely. It's a landmark piece of legislation, a real reset. So for you listening, the big question we're tackling today is this. Has Circle's strategy, always focusing on compliance, actually set them up to be the foundation for the U.S. digital dollar?
Because if it has, its value should look pretty solid.
Exactly. It implies a certain stability.
Okay, so let's get straight to the hook. As we record this, October 22nd, 2025, CRCL closed at $124.79 a share.
But here's the thing. When we run the numbers, look at the fundamentals. Our discounted cash flow model suggests the intrinsic value is, well, quite a bit higher. We're seeing something in the range of $136 to maybe $139 per share.
That's a noticeable gap. So what's holding it back? Why is the market seemingly discounting what looks like a fundamentally strong player?
That's what we need to unpack. There are some serious headwinds. We're talking macroeconomic factors, technical risks, things like really high short interest on the stock and its sensitivity to interest rates. These things are creating a real disconnect between the company's core story and its current price action.
We'll dig into all of that, but first, just a quick word about how we make these deep dives possible. Please remember to like and subscribe to Stock Analytics AI. A subscription, just $4.99 a month, unlocks our entire library. That's 500 deep dive videos covering the whole S&P 500.
And we're not stopping there. Next up, exclusively for our members, we're tackling the NASDAQ 100. Plus, as a member, you can request deep dives on specific stocks. Just drop the ticker in the comments and we'll get on it.
All right, let's dive into the analysis, starting with the core business itself.
Chapter 1, Business Analysis.
Okay, so Circle's business model. It looks simple on the surface, really built on two main pillars. The first one, the real powerhouse, is reserve income.
Yeah, that's the interest they earn on the huge pile of assets backing USDC.
And huge is the right word. What are we talking size-wise?
Well, as of Q3 2025, it was nearly $74 billion, mostly held in cash and very safe short-term U.S. government debt.
And the beauty of that is scalability, right? Every USDC out there is basically earning interest for Circle.
Pretty much. The operating costs don't scale nearly as fast as the reserves can grow. It's a very efficient model in that sense.
But it's not just about clipping coupons on treasuries. They have a second pillar, subscription and services.
Right, and that's potentially the higher margin side of the business. This includes things like transaction fees, platform services, developer APIs, basically tools for businesses to use USDC for payments. Think Circle Payments Network, Circle Gateway.
Okay, but there's a catch, isn't there? A tension in the model.
Definitely. It's the margin tension caused by these significant distribution payments. They pay partners like Coinbase a lot of money to help distribute USDC and get it adopted.
So that helps growth and network effects.
Which they absolutely need, but it eats directly into the net margin they make on that big pool of reserve income. So long-term, their success really hinges on scaling up that software and services side faster than these distribution costs grow.
Let's zoom out a bit. The whole stablecoin market, it's already big.
Oh, yeah. $166 billion by mid-2025. But the growth projections are, frankly, staggering. Some forecasts put it as high as $3.7 trillion by 2030.
Wow. And Circle's carving out a good piece of that.
They are second largest issuer, and they've been gaining share up to almost 29% in the third quarter of 2025.
Now let's talk about that regulatory mode. This seems like the absolute game changer.
It really is. For years, you had this kind of philosophical, even geopolitical clash. You had Circle regulated, transparent, onshore versus, say, Tenor, often seen as opaque, unregulated, offshore.
And the Genius Act just blew that whole dynamic up.
Completely. Circle's existing model, the 1.1 backing of safe assets, the audits, the licenses, it already met the tough new federal requirements, so the act didn't force them to change. It validated their approach.
It basically turned them into a quasi-regulated financial utility overnight.
That's a great way to put it. It tilted the playing field massively in their favor. Their competitive advantage now is heavily based on trust and transparency, which the act underscores.
Okay, makes sense. Let's shift gears from the business itself to the leadership.
Chapter 2. Management evaluation.
The CEO, Jeremy Allaire, he's got quite a background.
He does. He's not new to this tech game. A serial entrepreneur, remember Allaire Corporation and Cold Fusion. way back,
Hmm.
then Bright Cove.
Right, so he has a history of seeing waves of internet innovation coming and, well, riding them successfully.
Exactly. And that experience showed during the SVB crisis in March 2023. That was a real test.
Yeah, they had, what, $3.3 billion exposed? That caused some panic.
For sure. But management was quick, very transparent about the exposure, and crucially, they immediately moved the reserves to a safer haven, the Bank of New York Mellon. That swift action stabilized the USDC peg and, just as importantly, restored confidence almost immediately. It was textbook crisis management.
They also seem pretty strategic with their acquisitions, not just buying random things.
No, very focused. Acquiring Hashnote Holdings gave them a play in tokenized money market funds. But the really interesting one, I think, was Malachite in August 2025.
Why Malachite?
Because they bought it specifically to build ARC. That's their own proprietary Layer 1 blockchain designed just for stablecoin finance.
So they're not just issuing the coin, they want to own the underlying rails too, vertical integration.
Precisely. It signals real ambition to be a full-stack player in digital money. Not just the currency, but the infrastructure.
And speaking of strategic moves, hiring Heath Tarbert.
Yeah, the former CFTC chairman.
Yeah.
And then promoting him to president right before the Genius Act. Talk about perfect timing. That gives them incredible regulatory insight right at the top.
It's not all perfect, though. There was some criticism, wasn't there, about their terms of service?
Right, a minor point perhaps, but worth noting. They prohibited USDC use for firearms-related buys. Critics called it ideological enforcement. It just shows the balancing act they have to perform between regulation, platform rules, and user expectations.
And finally, capital policy. Pretty simple.
Very. They're in growth mode, all about reinvesting back into the business. So no dividends, no share buybacks planned. All focus is on expansion.
Okay, let's get into the financials.
Yeah.
Because this is where, as you said, things get a bit paradoxical.
Chapter 3, Financial Analysis.
The revenue growth, I mean, it's undeniable. There's $15 million in 2020 to $1.7 billion in 2024.
Explosive growth.
Yeah.
And Q2 2025 revenue is still up over 53% year over year. So the top line looks fantastic.
But then you see the bottom line for Q2 2025, a reported JEET net loss of $482 million. That sounds, well, terrible. Does that square with the growth story?
And that is the profitability paradox. It's probably the single most important financial point for you, the listener, to understand about Circle right now. That huge reported loss. It looks bad, but it was overwhelmingly driven by non-cash, one-time charges linked to their IPO.
Ah, okay. Like stock-based compensation.
Exactly. $424 million in stock-based comp, plus another $167 million from a debt charge. These are accounting items reflecting the IPO structure, not a reflection of the actual day-to-day business operations failing.
So strip out that accounting noise.
Yeah.
What's the real economic picture?
The underlying core business is actually quite profitable. In that very same quarter, Q2 2025, they reported adjusted EBITDA of $126 million, and that figure was up 52% year over year.
Right. So that shows the core operation is healthy and scaling.
Absolutely. It demonstrates significant operating leverage. The fundamental business, free from those one-time IPO hits, is generating solid, growing profits.
And the balance sheet supports that stability narrative.
It does. Very little debt. A debt-to-equity ratio of just 0.09, and a solid current ratio around 1.03. Financially, they look quite stable.
But the valuation metrics, they look pricey.
They do trade at a premium. Price to sales around 16x, price to book over 12x, and that forward PE of over 100x, well, that tells you the market is baking in massive future growth.
But you mentioned a hidden hint in the data, something about the WACC.
Yes, the weighted average cost of capital. It came in remarkably low at just 4.024%.
Which is unusual for a company perceived as being in the volatile crypto space.
Exactly. A WACC that low typically belongs to much lower risk businesses like utilities or established financial institutions. It suggests the market, or at least parts of it, might be starting to view Circle's core reserve income, that predictable interest stream, as being very low risk, almost like a regulated utilities cash flow.
That's fascinating. If the market fully embraces that view, it could justify a much higher valuation multiple eventually.
That's the implication, but it clearly hasn't fully embraced it yet, given the stock price volatility.
Which brings us perfectly to market sentiment and why there's such a disconnect.
Chapter 4, Market Sentiment.
Looking at Wall Street analysts, it's like they can't make up their minds.
It's completely split down the middle. 7 buys, 7 holds, 3 sells. That kind of division is pretty stark.
And that split leads to a huge range in price targets, right? From $84 on the low end to $280 on the high end.
Exactly. The average target is actually quite bullish, somewhere between $173 and $277 olds, well above the current price.
Okay, so analysts on average are bullish, but the technical picture, not so much.
Not at all. The technicals look pretty bearish right now. The share price, $124.79, is trading below both its 50-day moving average, which is around $131, and its 200-day average, around $136.
Signaling negative momentum in both the short and long term.
Correct. And adding to that negative pressure is the high short interest.
How high are we talking?
About 10.9% of the public float. That's over 15 million shares being shorted. That's a significant number.
So a large chunk of the market is actively betting against the stock.
Yes, and it's likely not just people thinking it's overvalued. Given the size, it suggests sophisticated investors might be using CRCL as a macro hedge, specifically a hedge against potential interest rate cuts.
Because rate cuts would directly hit Circle's main revenue source.
Precisely. If you expect rates to fall, shorting Circle becomes a way to play that view.
Interesting. Let's look at who actually owns the shares. That often explains volatility too.
Chapter 5, Ownership Structure.
So who holds CRCL? Is widely held?
Not really. Ownership is quite concentrated. You've got over 360 institutions involved. Big names like BlackRock, Vanguard, General Catalyst holding somewhere between a third and maybe 39% of the company.
And the top shareholders?
The top 25 control almost two-thirds of the company, about 63.7%. So yeah, fairly concentrated among large holders.
Now the insider trading data. That looks worrying at first glance. Lots of selling.
It does. If you just look at the raw number, 27 sell transactions versus only 4 buys in the last 3 months, you might think insiders are dumping stock, losing faith.
But there's a nuance there, isn't there? A critical one.
A very critical one. You have to dig deeper. The vast majority of those sells are not discretionary decisions by insiders to sell their shares on the open market. They're automatic, scheduled share withholdings.
Withholdings for what?
To cover taxes. When restricted stock units, or RSUs, vest, the employee owes income tax. Companies often automatically withhold and sell just enough shares to cover that tax bill. It looks like a sale on the transaction log, but it's not an insider actively choosing to reduce their stake because they think the stock is going down.
That's a really important distinction. The market might be misinterpreting routine tax transactions as negative sentiment.
It happens all the time. So you really have this barbell structure in the ownership. On one side, you have these long-term, sticky investors, venture capital, institutions holding for the fundamental story. On the other side, you have this large, active, short interest, likely driven by macro bets.
And that collision between long-term holders and short-term macro bettors explains the high volatility despite a stable core business.
That's a very plausible explanation for the stock's behavior, yes.
Okay, we understand the market crosscurrents. Let's synthesize the key risks now.
Chapter 6, Risk Assessment.
We've touched on strengths, the regulatory moat, the trust factor, and weaknesses, the margin pressure from distribution payments. But what's the biggest external cloud hanging over Circle?
Without a doubt, it's interest rate sensitivity. I mean, we keep coming back to it because it's so central.
Because their primary revenue stream, the reserve income, is directly tied to short-term rates.
Exactly. So if those economist forecasts are right and we see rate cuts coming later this year or into 2026, that will directly and significantly reduce Circle's main source of profit. It's their Achilles heel from a macro perspective.
What about competitive threats?
They're definitely intensifying. You've got major banks exploring stablecoins, PayPal launching its own. The space is getting more crowded. And then there's the longer term, maybe more existential threat from central bank digital currencies, CBDCs. If those gain traction, what role is left for private stablecoins?
A valid question. Any other nuances? Maybe geopolitical?
Well, there's the U.S. tariffs of 2025. They don't directly hit Circle's business model, of course, but indirectly. If tariffs increase the complexity and cost of global trade, that could actually boost demand for efficient, low-cost cross-border payment methods.
Like stablecoins. So a potential slight tailwind from an unexpected source.
Potentially, yes. It adds another layer to consider.
All right, let's try and pull all these threads together into a conclusion.
Chapter 7, Conclusion.
So, summarizing the bull case, Circle looks like the clear winner from the Genius Act. They have proven management that navigated a major crisis. And underneath the accounting noise, there's real growing profitability shown by the adjusted EBITDA.
That's the core bullish argument, but the bear case is equally clear. extreme vulnerability to falling interest rates, a valuation that's already pricing in a lot of growth, and currently negative market momentum driven by technical selling and high short interest.
And our valuation, based on discounted cash flows, lands where again?
Our analysis points to an intrinsic value range of $136 to $139 per share, which, compared to the current market price of around $124.79, suggests it's modestly undervalued.
So, the final outlook.
From a purely long-term fundamental viewpoint, the stock looks attractive, especially with its newfound status as a sort of regulated financial utility. The Genius Act provides a strong foundation. However, you absolutely cannot ignore the near-term risks. Investors need to be ready for continued volatility, driven mainly by interest rate uncertainty and those technical pressures from the short side.
Which leads us to our final provocative thought for you. Given that really low WACC calculation, the one suggesting the market sees the core business as low risk, like a utility.
How long will it take? How long will the market keep treating Circle like just another volatile tech or crypto stock before it fully recognizes and prices in this new identity, the identity of a stable, regulated entity that basically controls key infrastructure for digital money?
Something to ponder.
And if you found this deep dive valuable, please consider becoming a member of Stock Analytics AI. That subscription gets you the full S&P 500 library, the upcoming NASDAQ 100 series, and the ability to request deep dives on stocks you care about. Just drop the ticker in the comments.
And finally, our standard disclaimer. This analysis was generated by an AI system using the source materials provided. It's for educational purposes only and should definitely not be taken as financial advice. Always do your own thorough research or consult with a qualified financial advisor before making any investment decisions.